Two friends each have $100,000. Lease Larry buys a rental property. Crypto Kyle invests the exact same amount in the stock market. Both of them are convinced they made the smarter choice. They're both wrong because Larry forgot to count the time and Kyle forgot to count the risk. 20 years later, the answer surprises almost everyone. So let's make this fair. Larry and Kyle start with the same $100,000. They earn the same salary. They're the same age. They even live in the same city. The only difference is where they invest. So, which one actually ends up with more money? Let's do the math. Lease Larry doesn't believe real estate is just an investment. He believes it's a wealth-building machine. Here's why. When you buy a rental property, someone else helps pay for it. Every month, your tenants help cover the mortgage. Little by little, they're reducing your debt while you're building equity. And if the property's value increases, you benefit from that too. Now let's do the math. Larry uses $100,000 as a down payment to buy a $500,000 rental property. The remaining $400,000 comes from the bank. His monthly rent is $2,800. His mortgage payment is $2,200. That leaves him with about $600 in monthly cash flow. On top of that, every mortgage payment increases his ownership of the property. And if the home's value rises by just 10%, the property is now worth $550,000. That's a $50,000 increase on an investment that started with $100,000. That's the power of leverage. To Larry, it's the ultimate wealth-building strategy. Someone else helps pay the mortgage, the property grows in value, and every year, his equity continues to grow. Honestly, it's a very convincing argument, but before you decide real estate is the obvious winner, there are a few costs Larry hasn't mentioned yet. Before we hear Crypto Kyle's argument, let's be fair to Lease Larry. Real estate isn't as passive as it looks. Roofs need repairs, tenants move out, property taxes go up, insurance gets more expensive, and sometimes your rental property earns nothing at all. Those are the hidden costs Larry forgot to mention. But Crypto Kyle looks at all of that and smiles because he believes there's a much simpler way to build wealth. Here's why. When Kyle invests in the stock market, he isn't buying pieces of paper. He's buying pieces of real businesses. Businesses that sell products, generate billions in revenue, and keep growing year after year. The best part? Kyle doesn't have to fix a roof. He doesn't have to find tenants. He doesn't have to answer late-night phone calls. He simply invests and lets time do the work. Now let's do the math. Kyle invests the same $100,000. Instead of buying a property, he invests it in a low-cost index fund. If that investment grows by an average of 10% per year, after 20 years, it becomes roughly $673,000. That's an increase of more than $570,000 without borrowing money or managing a single property. That's the power of compound growth. Your returns start generating their own returns. Year after year, the investment keeps growing. To Kyle, that's real financial freedom. No repairs, no tenants, no mortgages. Just patience and time. Honestly, it's another very convincing argument. So now we've heard Larry's side, and we've heard Kyle's side. Both of them make wealth sound easy. But the truth is a little more complicated, because there's one thing they've both been ignoring. Let's do the real math. Not the version Larry tells you. Not the version Kyle tells you. The complete picture. Let's start with cash flow. Real estate wins. A good rental property can put money in your pocket. every single month. Stocks usually don't. Now let's look at diversification. Stocks win. With one investment, you can own hundreds of companies instead of putting all your money into a single property. Next, liquidity. Stocks win again. If you need your money tomorrow, you can usually sell your investments in minutes. Selling a house can take weeks, sometimes even months. Now let's talk about leverage. This round goes to Larry. Real estate allows you to control a large asset with a relatively small down payment. That's something the stock market simply doesn't offer to most long-term investors. But here's the category almost nobody talks about: time. Kyle wins this one. A rental property demands attention. Finding tenants, managing repairs, handling paperwork. An index fund asks for almost nothing. You invest, you wait, and you let time do the heavy lifting. So what's the score? Real estate wins. Cash flow and leverage. Stocks win. Diversification, liquidity, and simplicity. That's 3 rounds to 2. Does that mean stocks are the better investment? Not so fast, because the best investment depends on something more important than the numbers. It depends on you. So, which investment wins? The answer is neither. Because the best investment is the one you can stick with. If managing tenants, repairing properties, and using leverage excites you, real estate can build incredible wealth. But if you prefer simplicity, diversification, and letting compound growth work quietly in the background, stocks are an amazing choice. The biggest mistake isn't choosing real estate, and it isn't choosing stocks, it's spending years arguing instead of investing. Because while Larry and Kyle were debating, Boomer Bill quietly started investing 20 years ago. He didn't spend his time trying to find the perfect investment. He picked a strategy, stayed consistent, ignored the noise, and let time do what time does best: build wealth. That's the lesson almost everyone misses. Your first investment doesn't have to be perfect. It just has to begin. Because the real competition was never real estate versus stocks. It was investing versus waiting. So which one will make you more money? The one you actually start.